Can I have the presentation? Okay. Good evening, everyone. This is Abhijit from Kotak Securities Commodities Research Desk. So today I would be giving options Wednesday webinar, how to trade commodities with option strategies. I'm working as a senior manager in commodities research team in Worli office. Can we have the presentation now? Okay, so what would be our today's agenda in this webinar? Like, what would we be learning? So first of all, different types of option strategies. Okay, and when to use those option strategies on commodities. Like, since there are many option strategies in the market, but basically we are just going to cover three option strategies, out of which one would be a bullish option strategy, two would be a bearish option strategy, and three is a market neutral, which is a non-directional option strategy. So we would be covering three option strategies today, and I would be also explaining like which specific strategies should be used in which scenarios. Okay. I would be also explaining you the price dynamics, the payoff charts, and the margin requirements. And I would be giving you the live, like the examples of commodities, uh, and I will be showing you implementing those strategies. So, as I mentioned you, I would be, explaining three strategies. Now, the bullish strategy, the first strategy is the bull call spread strategy. Okay. The second is the bearish strategy, which is the bear put spread strategy. And the third neutral or the non-directional strategy, which I told you would be the long straddle strategy. Okay. I would be also telling you in which scenarios, which strategy one should use or apply. Now, first, starting with the bullish option strategy. Now, this is a bull call spread strategy. Now, what is a bull call spread strategy? A bull call spread is a type of options trading strategy that involves two call options. So this is a multi-leg strategy. All the three option strategies which I'm going to discuss today are multi-leg strategies. So they would be having two legs of options in a strategy. So a bull call strategy is executed by purchasing call options at a specific strike price or exercise price while also selling the same number of calls of the same asset at a higher strike price. It should be noted that the both options should have the same expiration date. Now, while choosing a bull call spread strategy, okay, now what are the key takeaways? When the first point, if you see here, is a bull call spread is an option strategy used when a trader is betting that an asset will have a limited increase in price. Now, let's say there is a breakout scenario where you are expecting a commodity, gold, silver, crude, any one of the commodity which have options, and you think that it might move higher, but you are not super bullish, but you think there are chances that market might move higher from this point of breakout. In this case scenario, you can use a bull call spread strategy. So what is done actually? There are this strategy is since it's a multi-leg strategy, you have to buy the in the money call option, and you have to sell the out of the money call option. Now, you see the second point over here, which says the strategy uses two call options to create a range consisting of a lower in the money strike price and upper out of the money strike price. So the bullish call spread can limit the losses of owning the assets, but also caps the gain. So now here, the third point says is now since your profit is limited, so are your losses. Okay, so it's a very minimal risk and minimal profit gain strategy where two call options you have to enter. Now let's say for example gold is trading at around 75,000, and where you see I will also showing you the example. specifically for the gold only, and when you have to apply this strategy. So first, basically, you have to understand you have to buy one call option which should be in the money, and you have to sell another call option of the same commodity and of the same strike price and same expiry. But that would be the out of the money option. Now, let's say for currently, if gold mini December, it is the options expiry is December, then you will have to buy in the money gold mini call option of the same expiry, which would be December. And you will also have to sell the out of the money call option, which is having the same expiry, which is December. Okay. Now, let us go with the example. Okay. Now, also before moving forward, as I mentioned you, what are the risks and rewards and what would be the break even of this strategy? Now, risk is limited. Okay, the maximum loss is limited to the net premium paid. Now, what is the net premium? See, you would be buying a call option and you would be selling a call option. Okay, so what would be the net? So, whenever you sell a call option, you receive a premium. Now, let's say, for example, the call option which you're buying, let's say it's quoting at around 100 rupees. The premium is 100. The call option which you would be selling is, let's say, is quoting at around 30 rupees since it's a out of the money option. So you're buying at 100 and when you're selling an option, you would be receiving 30 rupees. So the net premium you are actually giving is 70 rupees. That is 100 minus 30. So the maximum loss that you can have would be the 70 rupees on this strategy. Okay. What are the rewards? Now the rewards are also limited. Now, those are the difference between the two strike prices minus the net premium. Now, let's say if you are, let's say for the crude oil, let's say the two strike prices that you choose are at a difference of 200 points. So 6,500 and 6,700. So 200 difference minus the net premium. Let's say in this case, you have paid a premium of 70 rupees. So minus that. So which would be around 130 would be your maximum loss. I'm sorry, maximum profit. So rewards are also limited and the risk is also limited. And what is the break even? Break even is also limited. Strike price of a purchased call plus net premium paid. Now, in this scenario, in the money call option which we would be buying would be the strike price of a purchased call. You have to add the total net premium paid, which in our case was 70 rupees, plus the strike price of the call option which you have bought, which is in the money. Okay, I'll quickly show you the examples also, so that while seeing the example, you would be in a better position to understand the strategy. Now, first and the most important thing is to decide when to buy this strategy. Okay, now you can see in front of you is the gold mini futures chart. Okay, and this is the daily chart that I have seen that I'm showing you, and you can see on 9th of December, that was on Monday. Okay, there was a breakout of the consolidation. You can see a green candle that is breaching and closing above this falling trend line. Okay, and it is also closing above the consolidation that was forming since last 2 weeks. Okay, so it gave a very good bullish candle. It closed about 20 EMA. It is above super trend. RSI is also giving a positive sign. So all scenarios, if we see the indicators and also the price action, we see a very bullish signal over here. Now, what we can do is, now this in this scenario where I'm not very much 100% sure that it might move up. I'm moderately sure that, yeah, considering the consolidation, it might move up a little bit. Okay, now in this case, rather than just buying a call option, what I would do is I would buy a bull call spread strategy, which we are discussing now. Now, in this case, as I told you, we have a two-leg strategy where the one leg is in the money and one would be the out of the money. Now, if you see on 9th of December, the closing of this daily candle was around 76,999, which is almost 77,000. Now, let's say what would be the in the money call option. Obviously, in the money strike price would be the 75,000 call option. Okay, which would be almost in the money by 71,000. Means quoting around 77,000. It has closed at 77,000 futures. So if I go with the 76,000 call option strike price for gold mini December future, which is the nearest month expiry, that would be the in the money call option. And out of the money, I would go with the 78,000. So 1,000 from what it is quoting, 1,000 downside, which would be in the money, and 1,000 outside would be the out of the money. So I would be buying in the money call option with a strike of 76,000, and I would be selling call option with a strike of 78,000. Okay. Now, what would happen if I do that? Now, this is the payoff chart that would be which would happen if I go with the position which I mentioned. You can see at the top left corner, I've taken a buy position in call option with a strike of 76,000. Now the market price which you see, that is the closing approximate closing price of that option on that particular day. So on 9th of December, 76,000 call option of gold mini December expiry closed around 1419 level. Okay. And 78,000 call option with the same expiry, December expiry, closed around 492 levels. So what I have done is I have taken a buy position one lot at 1419, and I have short sell one lot of 78,000 call option at 492. So as I mentioned earlier, the net premium concept. So if you see the net premium concept, you can see it is at around 927, 9270 is the total net premium that I paid, because I would be paying 1419 to buy an option. Since I'm buying an option, so I would have to pay that. But now, since I'm also selling an option, I would be receiving a premium of 492 for the 78,000 call option price. Okay, and this is the payoff chart that would be happening if I'm going to go long on the bull call spread option strategy. Now, what are the scenarios? Now, what would be the maximum profit? What would be the maximum loss that I can have if I'm going to now, since I have entered this position at on the closing basis. Now you might have a better opportunities when you're trading intraday, but now since it's a bit difficult to fetch out the intraday historical data of the options, I have taken a daily closing basis example for this particular strategy. Now see, these are the scenarios. Okay, but make a note that these scenarios are on the expiry day. Okay, so if you see, since even if let's say the gold mini, as per our prediction, as per our forecast, let's say it didn't work out, and let's say from the next day it started falling. So what would be the maximum loss that we can have? Now you can see that the maximum loss that we can have is 9270. Okay, now since because we also have a short call position, we would be having a maximum limited loss of 9270. We cannot have a loss more than 9270. But on profit side also, we would be having the maximum profit of 10,730. No matter gold mini goes 5% up, yeah, more than that, still the profit is also limited. So we would be having the maximum profit of 10,730. So the maximum loss and maximum profit is defined, but those scenarios are as per on the day of expiry. Now since if you are taking a short term call, let's say as per that pattern, let's say you are just holding it for a couple of days, then you might get an opportunity to exit with a good profit. Okay, now let's say what we have just taken a BTST call, like buy today, sell tomorrow, just for one day. Okay, now see the scenario. Since you saw that later that day, the second day, gold open gap up and it moved higher. Even today it open gap up and move higher, but I am not considering today's move. I would be just taking yesterday's closing, just a small move which it made after the Monday's closing. So let's say on 10th of December, those are the closing prices of those options. Okay. So on 10th of December, we see that 76,000 gold mini December call option, it closed at 1953, while the 78,000 call option closed at 710. Now, let's say if you would have taken that bull call spread option strategy on the closing of 9 December, and you just have waited for a single day, and if you would have, squared it off on 10th of December, you would be having the profit of around, let's say, approximately around 300 rupees, more than 300, because the first net premium which you see you paid was 927, and then when you sold your both the legs, both the position, your premium was 1243. So that is like more than 300 points of premium that you booked profit in a single day. Now, obviously, if you would have kept it for second day also, your profit might have been higher. Now, but that depends upon your risk appetite. How long you want to wait. If you're still bullish after that move, that you still think that gold mini might move higher from here also, then you can hold on to your positions, and you might have booked higher profits in the same position. Okay, so this was the bull call spread strategy, and this is actually bought or executed whenever you feel a particular commodity is going to move higher. Okay, moderately to higher. It's not like you are a super bullish, because if you're very super bullish, then you can just buy a call option. Okay, but when you are like not so sure, so in that case you can take a bull call spread strategy, because the premium that you would be paying would be a much lesser compared to just buying a naked call option. Now we will be moving towards a second strategy. Now this is a bearish strategy. Okay, first one which we discussed was the bullish strategy. Whenever you think markets are going to go up, this second strategy is for the bearish strategy. Whenever particular commodity, if you think is going to fall, then in that scenario you can take a bear put spread. Now, what is a bear put spread? It's an option strategy used when a bearish market view is there. The strategy minimize your risk in the event of prime movements going against your expectations. So let's say if you are expecting a fall, but let's say market goes against you, in that case you can minimize your risk, and it would be a less compared to just buying a naked put option. Okay, so similarly, how we entered the bull call spread, the bear put spread is also somewhat similar, but now here you sell out of the money put option and you buy in the money put option. Okay. In bull call spread, the previous first strategy, what you did was you bought in the money call option and you sold out of the money call option. Similarly, in a bear put spread, you have to buy in the money put and you have to sell out of the money put option. Okay. So again, similarly, the risk is limited because the maximum loss is limited to the net premium paid. The net premium, like in the money put option, which you are going to buy, minus the out of the call put option, which you're going to sell. Okay, the total premium that you will be paying is the only loss that is the only maximum loss that you would be having if the strategies goes against your view. Now, similarly, the rewards are also limited. Similarly, like the first strategy we discussed, limited to the difference between the two strike prices minus the net premium. Okay. Maximum profit is the difference between the strike prices. Okay. Now, let's see when you would be, entering those strategy, like when you would be going with a bear put strategy. Now, if you see on 4th of December, now this is a crude oil future, December future chart, and this is a daily chart that I am showing you on your screen. So if you see the red candle, it's written dark cloud cover, which was formed on 4th of December 2024. You see, this was the third time that crude oil, respected the resistance of the falling trend line. Okay, and it just touched that trend line. It fell and it closed more than half of that green candle, forming a dark cloud cover candlestick pattern. Now, this candlestick pattern is a bearish candlestick pattern. Now, you have two confirmation. First is the candlestick pattern, which is dark cloud cover. And second, it also, respected the falling trend line. Okay, you can also, add on any indicators if you're specifically using, just to confirm, the bearish sign that it has given. Now, in this case, what I would do is I would go for my view will be a bearish view. Okay. So now in this case, what I would do is now there are multiple options. If I'm a very speculative risk trader, I can just short a future. I can just take a, put option of this crude oil. Or else, if I want to minimize the risk, I'm not, very much sure, but I'm moderately having a bearish view that I'm thinking, yeah, it might move downwards. Now in that case, I would go with a bear put spread strategy. Okay, so if we see the closing of this is somewhere around 5850. I mean, the futures on this day close somewhere around 5850. So what I've done is, let's say 5850, what would be the in the money prices? Now, whatever below 5850 would be the, let's say, like if I go 5700, 5600 for a put option, now that will be the out of the money options. And if I'm going higher, like 5900, 6100, that will be the in the money prices for the put options. So as I mentioned earlier, for the bear put strategy, you are going to buy in the money put and you are going to sell a out of the money put option. So what we have did here is, we have buy in the money put option with a strike price of 6,000, and the expiry is December, the ongoing expiry. Okay. And we have sold a put option with the same expiry, December expiry, but having a strike price of 5700. Now, since the future was trading at around 5850, so 5700 becomes the out of the money strike, and 6000 become the in the money strike for the put options. So again, on this day, I have taken the closing prices of both the options. So if we see the 6000 put option closed at 214, okay, which we bought a one lot of put option at 214. Simultaneously, we sold one lot of put option with the strike price of 5700 at rupees 64. So if you minus 214 minus 64, it will be 150 rupees. So net premium paid is 150 multiplied by 100, since the lot sizes of the crude futures and option is 100. So it is 15,000. So 15,000 total rupees would be required to enter this strategy. Okay. Now, what would happen if I would have just taken a normal put option? If I've just taken a buy option, then I would, was obliged to pay 240 into 100, which is 21,400 rupees just to buy a single put option. But now with this strategy, my total net paying this thing amount would be 15,000 rupees. I mean, the net premium paid will be the 15,000 rupees for the strategy. Yeah, but there's one more scenario where whenever you are selling an option, okay, the total margin required won't be higher, because whenever you're selling an option, futures margin is been calculated. Okay. So whatever the crude oil futures margin is there, that will be blocked whenever you are selling an option. You might be getting some leverage since you are also buying a put option. Okay. But again, that would be minimal. Okay, it's not like it will be a complete hedge position. There might be some, payoff of the margin when you're buying a put, and when you're, selling this thing of futures margin. I mean, when the future margins is getting blocked when you're selling a option, this thing. Whenever single option has been sold, the particular futures margin is blocked for that particular leg. Okay, now this is the payoff a chart that has been generated when entering a bear put strategy with 6,000 and 5,700 strike price. Now we would move forward to see the scenarios, what will be happening uh, with pricing, prices closing at certain strike levels. Now, since this is the scenarios at the expiry day, okay, so now let's say if you see the maximum loss, let's say your view is bearish, but let's say unfortunately market starts moving up. Okay, So at 5950, let's say market moves up by 100 points. Okay, futures moves 100 points upside against your view. You will be having a maximum loss of 10,000. Let's say it move higher till 6,000. Now from 6,000 onward, you see the maximum loss is fixed at 15,000 rupees. So let's say market completely reversed at 6,000, and then no matter where it went after that, 6,000, 6,200, 6,300, but the maximum loss that you would be having would be 15,000 only. But in case, let's say, if you would have bought a naked put option at 214, which you would have total margin required would be at around 21,400, the net premium paid. So let's say till expiry, it never came down and it just went against your direction. The total loss would be 21,400, where your option premium becomes zero. Okay, when the on the day of expiry, if it is not below your strike price. But in this case, you see when you are entering into a strategy, the maximum loss is 15,000. Yeah, but there is also a disadvantage that the maximum profit is also capped. So if you see, no matter how much crude oil fall from there, from 5,700 rupees and below that, the profit is also fixed. So the profit is 15,000. The maximum profit is 15,000 only uh, when crude oil starts moving lower as per your view. Okay. So now here are, since we discussed the scenarios on gold mini. Here also, if you see, for let's say you bought those strategy on 4th of December, and let's say you would have hold that just for 2 days. So on 6th of December, if you see the closing price, okay, so that in the money put option, uh, which was 6,000 put option for December expiry for crude oil, it went from 214 to 291. Okay, so it closed at 291. So it moved almost by around 65 points, 65, 67 points. But the out of the money put option did not increase how the 6,000 put increase, since it was the out of the money. So 5,700 was the out of the money put option, which got increased from 64 to 84 only. So now if you see the net difference, okay, now so if you would have entered the strategy on a closing basis on the 6th of December, if you would have closed the strategy on end of the day, okay, you might have got more profits during the intraday, but I'm just taking the closing, since as I mentioned, it's difficult to fetch out the historical intraday data for the options. So I'm just over here taking the closing intraday options data. So the difference you can see is 150 for when you're entering the strategy, but when you're exiting the strategy, the difference is 207. So 57 rupees is the net profit that you earned by entering into this bear put strategy in crude oil. Okay. So these were the two strategies that we discussed. The first one was a bullish bull call spread strategy. The second one was the bearish strategy, which is the bear put spread strategy. Whenever you had the bear or the negative view on the option, you can go with the second strategy. Now, what if you do not have any particular view on the direction? On what would you be doing? Now, see, there are multiple scenarios where you can enter such strategy. The most exciting time, I think, for the non-directional strategy on a weekly basis is whenever we are having crude oil inventories or natural gas inventories, where we see high volatility during that particular, set of time. So now let's say, because see, no one is sure that what inventory would be coming. But one thing we are sure of is that volatility is going to be increased. So whenever, let's say, there is a drastic changes in the inventories, we see spikes in volumes as well as fluctuation in the prices. So what happens is that the volatility shoots up. Now in this scenario, see, now I'm actually going to talk to you about the straddle strategy. But now straddle can be used in both ways. When you are expecting a spike or a shoot in volatility, you go long with straddle. Okay. But in same scenario, let's say there is a sideways market and you're not expecting any movement, let's say there is not even any economic data, and you don't think there would be any volatility or any spike in prices, in that case you can go short straddle. But what interests me on a weekly basis is the crude oil and natural gas inventories, where one can actually use this long straddle strategy. Because at 9 o'clock or at 8 o'clock, when I'm unsure of the inventories prices that are going to inventories going to uh, come out. So in that case, what I'm sure is that I'm sure that volatility is chance. I mean, there is a probability where volatility could increase in such scenarios. Then in that case, I would be building a long straddle strategy before the inventory. Now that could be around 5 p.m., 6 p.m. It's up to you. You'll have to start trading and see to yourself, experience yourself when is the best buy to enter the long straddle strategy. Okay, but the best time is obviously it is before the inventory comes out. Okay, so see, the long straddle or a buy straddle is a neutral strategy. This strategy involves simultaneously buying of a call option and a put option of the same underlying asset, of the same strike price and the same expiry date. A long straddle strategy is used in case of high volatile market scenarios where you expect a big movement in the price of an underlying but are not sure of the direction. So now, see, I have discussed the inventory scenario, but now there could be multiple scenarios. Most of the time you see US economy data like non-farm payroll or retail sales or core PPI. Those are some important data, which come out in the evening session. Now, when you are not very much sure, but you are, expecting a very good movement or very high movement in such scenarios, you can go a long straddle on gold mini. You can go a long straddle on silver mini options. In case of inventories for crude oil, natural gas, you can go, long straddle just before the inventory. I would be giving you the example also, specifically for the crude oil. But yes, you can use long straddle before the inventory for crude oil and natural gases. You can also use long straddle whenever there is a very, a three-star economic data, which affects US dollar, which then indirectly, directly, affects bullion prices. So you can go long straddle with gold and silver also when there is a very major economic data that's going to come out in the evening session. Okay, so what is done over here? In long straddle, you buy a call option, and you also buy a put option with the same strike price, okay, of a same underlying and same expiry. Okay, now see, uh, if you are just going for that specific move, then you can just entry and you can get out on intraday basis only. Now, if you see there is you expect a volatility to rise, on a daily basis, and you expect that market is, the volatility is going to rise for coming few days, then you can hold on to your straddle strategy for a couple of days, or let's say for a week's time. But in those scenarios where I expect, when you are just expecting volatility spike for this economic data or inventories data, then it is better to just entry and exit on an intraday basis only. When you just have that moment, you exit, you book whatever profit you have on the strategy, and then you exit the strategy. Now, a long straddle is an option strategy where traded buys a long and put on the same underlying with same expiration, which we discussed. The goal of a long straddle is to profit from a strong move in the market, usually triggered by a newsworthy event. Now, it could be any event, it could be Fed interest rate decision, it could be any economic data, it could be any inventory data. Okay. Now, let's say this is an example. Okay. Okay, I do not have the chart, but this is the same chart of crude oil on an intraday basis. Now, let's say this was actually Wednesday on 4th of December. Okay. Yeah, it was Wednesday on 4th of December when crude oil inventory prices was going to flash. I mean, they were going to come out. Inventory data was going to come out on last Wednesday on 4th of December. So I do not have an intraday chart over here now, but you can figure out that we have a, we had a this thing bearish move specifically after the actually inventory data came out. Well, just after evening, we had a fall in crude oil prices. So what I did is I have taken this closing prices. Okay, first of all, I have taken a strike price of 6,000 for which I bought a call option on 4th of December at 190, and I have taken a put option of 6,000 strike price with same expiry, which is December, at 150 rupees. So 150 plus 190, it is 269 rupees that the premium I paid into 100. So 26,900 is the total amount that I would be paying. Now, since I'm buying both the option, the maximum margin that I would be, giving is 26,900 only. I won't be, required any additional margin since I'm not selling any option contract. I'm not shorting any option contract, which we had earlier in bull call spread and bear put spread. Here, only simply buying option is done in this long straddle strategy. Okay, you can see the payoff diagram. Where is your break even? Like, either side. Because see, direction doesn't matter in this. You just need a one side direction movement, okay, to be in profit when you're going long on straddle options. Okay, now this is the example. Now this is the maximum loss and maximum profit. Okay, so 23,100 is the maximum loss. 23,100 is the maximum. I'm sorry. 26,900 is the maximum loss that would we be having, and 23,100 is the maximum profit on either side of when we have a this thing move, we would be having. Now, let's say this position which I took is on 4th of December, which was Wednesday. This I took on 5 p.m. in the evening, okay, because inventory data came at around 9 p.m. So I entered this long position at around 269 rupees, the total net premium paid as I discussed earlier. And after the inventory came, crude oil fell drastically. Okay, now I might be having more profit in intraday, but we have to be, very, uh, what we say, we have to be very cautious and to see when we are getting maximum profit. Now in this case scenario, I have just taken the closing price. Now closing price on 4th of December was around 214 for the call option, and sorry, 214, this is the put option. 6,000 put became 214, okay, which was 150, and the call option became 62 rupees, which was 190. So the difference is at around 207. The total sum is 207. Okay. No, I'm sorry. Actually, it's not 207. It's 276. So 276 is the total profit. So initially my amount was 269, and the by end of the day it was 276. However, the profit is not much. Okay, it's just 7 points. But there are scenarios where you can have 15 points or 20 points also when you have a very one side direction in crude oil after the inventory comes out. So it depends. You can also, try this kind of long straddle strategy on natural gas also, just before the inventory. But what you can do is you can do try to do paper trade for a couple of weeks, and then once you get a gist of the strategy, and then you can just actually go and start actually trading with those strategies. So that's all from my side. I would like if anyone would be having any questions on the strategy that we discussed. If anyone has any questions, they are welcome. Okay, Mr. Kuljit is asking crude oil view today, sir. You can ask questions related to this webinar or this, option strategies. For view, you can call the dealing team or your respective branch for the crude oil view. Okay, since there are no more questions, so we would be ending our webinar. Yeah, for views and for calls, I would suggest you can connect with us on our Telegram channel, commodity focus back for Kotak Securities, where you would be getting intraday and positional calls as well as news and economic updates as well. Okay, so thank you for connecting with us. Thank you everyone for listening me and attending this webinar.